We propose to tell you the story of the benchmark 10-year yield, which saw intense drama over a short period of 2 years. By August 2013, in the middle of an easing cycle, the yield moved back to 9%, a level seen at the end of the tightening cycle in 2011. Another easing cycle with little to smile about. In September 2011, the auction calendar announced a higher fiscal deficit than budgeted. Yields rose to 9% by November. In 2012, monetary easing began and yields began to drop. The coming in of FIIs, lower inflation and easy money policy saw rates fall below 7.4%. The events of June and July 2013 on both global and currency fronts led to the yield going back to 9%. Cut back to 2011. Contrary to the market expectation that yields will go up until the budget was announced in February 2012, the yields began to fall. There were three reasons why the yields dropped to 8.2% by February 2012. First, RBI purchased almost Rs 90,000 crores of bonds, mostly offsetting the additional borrowing needed to fund the fiscal deficit. Second, inflation dropped to 7.7% from the earlier high of 9%. Third, RBI announced a pause in rate hikes, signaling a reversal in monetary policy. By Jan 2012, CRR cuts were announced, but year-end pressures kept the yield high as there was a record high LAF borrowing in March. The rate cut of 50 bips in April did not send the yields down. 1. The RBI indicated that it was front-ending the cut, meaning further cuts may not come soon. 2. S&P put India on a rating watch. It looked like yields would be in the 8.5 to 9% range mostly. Market players expected rate cuts which never came. Headline inflation declined and OMO purchases of Rs 679 billion ensured liquidity, keeping the rate down. Rates declined a bit and remained near 8.25% through the rest of 2012. Markets expected RBI to act given low inflation and fiscal deficit in control at 4.8%. But there was no other major policy event in this period. Credit growth of banks continued to exceed deposit growth in October 2012. This was followed by a CRR cut made to ease the festive season demand. By December 2012, the expectation for a rate cut in January 2013 began to build up. RBI continued to purchase bonds through OMO. There was a repo cut and CRR rate cut in Jan 2013. Due to year-end liquidity crunch, yields spiked in March. The relaxation of FII investment limits took the yield down further. By May 2013, debt markets were bullish, having dropped almost 1% in 6 months. It seemed like the party finally began. The benchmark yield fell steadily up to May 2013. In June 2013, the Fed indicated a possible tapering of its asset purchase program. FIIs drew money out of the markets, triggering a rupee depreciation. High current account deficits made the problem worse. By mid-July, RBI announced a surprise hike of 2% in MSF rates. This spooked the debt markets into modifying their expectations for rates. The worry was that rates would remain high until the rupee was in control. The benchmark yield raised past 9% in August 2013. This timeline of Indian benchmark yields is a classic example of how forming expectations for long-term yield is tough. In less than 2 years, yields have moved down and back up. An easy policy regime was what the market expected, but what it got instead was a liquidity-driven fall in yields and a tightening-led spike to save the currency. Meanwhile, GDP growth has fallen to 4.4%. Unless RBI indicates that the focus is back to enabling growth rather than protecting the rupee, yields are unlikely to trend down significantly.